Good morning. In this video, I want to talk about the bottom line, something that every trader hopes to make in their trading on a daily or weekly basis. Profits, real money. That isn't always easy to achieve in a market that is just hell-bent on taking yours, but it can be done at a cost, whether it's patience, hours behind the screen analyzing the market, building a repertoire of tools and resources, or spending hideous amounts of time combing through papers, prospectuses, and market analysts' reports to try to determine which way the market is going. This is the whole point of the process, to make money. And on this chart, my equity curve is what I've done since the last time I reset my accounts. Now, a reset for me is when I sold off the entire asset. I stop the bot, and then I reevaluate everything in terms of what that bot has done and where I want to go again. So as you can see from the last time that I reset the bot over with roughly the middle of July until, well, yesterday, my own equity curve, including a stop loss I took. Now, it doesn't look impressive to only make $130 within roughly 2.5 months, but realistically it is very impressive considering that the market has just been a total and complete nightmare to work in. We are coming off of 9 straight weeks of Euro USD being in a bearish state. That is an unprecedented market situation, and it has repercussions and implications across every single market, including cryptocurrencies. Having that level of weakness within the euro and then comparing and correlating it against the US dollar and Canadian dollars clearly shows there is a major market change in the works. What that change is at this point is still questionable, but nonetheless, it still turned out to be a very profitable market. Now, the one thing that I need to emphasize from my own personal trading standpoint, so that you have context of the kind of trading I do when you look at my results, I prefer only shorting, or I am basically what is called a perma-bear. Now, there are ramifications and repercussions for that, particularly in markets like USD Canadian when they rally hard as they have done. USD Canadian has picked up a huge amount of traffic and a bullish run that has been quite favorable. My account accumulates quite a bit of positions, and I'm going to show an example of just how extreme that accumulation can be. But overall, if you plan out for your market and you're willing to take the risks, it can be very profitable. The kind of trading that I do personally is a devil's sword in many ways. In order for me to make money, I have to deliberately trade against the market, which means I have higher than normal risk levels because I have to have huge amounts of accumulations to turn that into real hard currency. And the ramifications are I can take some very wicked stop losses. And I'm going to demonstrate that as well, and just how bad this theory can get if you are too aggressive. And I made that mistake in the middle of the summer where I was too aggressive, and it bit me badly. It really brutally hurt my account. So figuring out your aggression level as part of your risk mitigation technique is absolutely critical, because if you don't think about the consequences of your trading in terms of the worst case scenario, it will wreck you. And it nearly did wreck my portfolio. I got lucky, to be very honest. A lot of my safeguards triggered and kept me from losing a lot more than I did. But nonetheless, I still lost a significant amount of money. Now, this is my real account. So you need to be aware of the circumstances of trading. The very first thing you have to think about is risk. I know I beat this horse dead, senseless, and back to life countless times, but it can't be overstated enough. When you trade, you have to think about the circumstance, and you have to have the mindset that money is not coming back into your account. Risk is the very foundation of your trading approach, and you really have to think about it. This is exactly why you have to think about risk first and foremost. This is where I got too aggressive. Aggression can destroy your account. I got too aggressive and I got nailed for it. So whatever your risk is, always cut it in half. That means if you think you can handle a risk of $1,000, cut it in half and only allow 500. And if you want to be defensive, cut it in half again and only allow 25%. Risk is very real in a market that is very unpredictable, because you can't gauge where it will go. And that is exactly what happened here. I couldn't gauge where it went, and it slaughtered me. 13 back-to-back stop losses and cataclysmic rates. My portfolio didn't survive. I made very, very, very little in terms of cumulative. I had an equity of $400 earned, and I almost went to zero of my earnings. Now, this is my profits only, not my base budget. So, again, protecting your original budget is absolutely critical. This was just profit. As long as I have my original budget, I can make profit over. But as soon as you start cutting into your original budget, you start cutting into the means you need to make profit. And that is really the biggest problem and mistake traders do on a repeated basis. They don't protect their original budget. So let's go through and look at the entire chart. The real look from the point that I started trading. Here is my entire history of trading. And you can see I did well. I accumulated well, I did well, I made a lot of good money. Again, these are profits only, not the actual budget. I took some losses, I stopped the bot, I reevaluated, and I made even more profits. Then I did something stupid. I took on too much risk. I thought the market was going in my favor. I got stupid and I changed my settings. And it decimated my profit curve. I made changes here. I was able to recover some of it, but then the big cataclysmic drop, the killer, move. And it really finished that process. Aggregation was my best friend. And that is how I made all of these profits, was aggregation of very small position sizes. When I moved to larger position sizes and I screwed up my scaling, I suffered. Not every situation can be scaled. Sometimes the assets you trade will do well at $5 or $10, but as soon as you move to $100, they slaughter you. Scaling is one of the most difficult aspects of trading, because as you look to increase your profits, if you cross a certain point in your scaling, you'll end up losing more than you make. And this is exactly what happened here. My scaling got too large, and it crushed my profits in a very bad way. I reset the bot, learned my lesson, reset my scaling, and yet, lo and behold, I am making profits again. Aggregation is the secret of success. The goal is to not take on too much risk. This particular run doesn't look impressive overall compared to this run, but this run used 30 to 40% margin, so it was able to accumulate a lot faster. The market was also predominantly bullish in terms of the direction I wanted to go. This market has been pretty much the exact opposite of where I wanted to go, and I've been able to still reasonably make money because of aggregation and significantly reducing my risks. My current bot now only uses 10% or less of my margin, which means I have 90% of my money just sitting there waiting. And as you can see, it's working. I'm going to take stop losses, and I'm going to take losses normally. That's just a part of the game, a part of the strategy, a part of the circumstance. But it's when aggression gets in the way and you make stupid mistakes that you wipe yourself out. Even the worst case flipping a coin approach for buying and selling will make money as long as you manage your risk. And that is really the whole point of the process. You have to manage your risk. Traders will often talk about their edge. I'm going to say it plain and simple, no mincing words here. Anybody that says they have a secret edge that isn't strictly managing risk is full of shit. They're speaking out of their asses trying to take your money. The only true edge in the market, no matter what technique you use, is risk management. If you can manage your risks, you will survive the market. If you get greedy, if you get aggressive, if you start fearing about losing money, the market is going to destroy you. The very first thing you have to do, and the very last thing you have to do, is manage your risks. Stop loss or accumulation, the technique itself really doesn't matter if you have good risk management. There can be no overstating that very basic principle fact of trading. Risk management is everything. Now let's take a look at some actual examples, both real and demo, of some of how my profits really unfold. and what I look for and why I trade the way I do. This is the 20 pip challenge demo that I have been demonstrating for the Learning Python series. It is a wonderful success. This process is just phenomenal because it does the one most important thing that is absolutely critical. It protects the original budget as much as reasonably possible for the type of strategy and approach it is. Now, there are losses, and this is my final balance. For a $100 account, having only lost 54 cents is remarkable for the number of trades that it has done. This is what people often look for when they look at a stop-loss based strategy. Stop-loss doing what it's supposed to do, mitigating the losses as much as possible. Now, profit-wise, this kind of a technique sucks. It is horrible because the best return it will make, roughly speaking, is 1 to 3% profit per year. And that is standard and par for the course for any stop-loss strategy average. You are going to get some that are going to be lucky. You are going to get some that are going to be unlucky. But the average is 1% to 3% of your budget will be your profit per year. So if you have a $1,000 budget, you can expect after 1 year, this particular process will earn you $10. That is not what I'm spending my time for. It works, it is beautifully successful, but I am not spending a year just to earn $10. I'm not looking to be able to make a house payment on what I earn, but realistically, I want more than that. And that is why I built the whole entire accumulation framework at Jackrabbit TV. So let's take a look at the process, this mathematical formula, meaning the three moving averages. Let's see how it looks as an accumulation strategy. Here we are, an accumulation strategy. And as you can see, it is very slow. But it has made a whole whopping, miserable 10 cents, 4 cents, 4 pennies. Accumulation only. Now, the strategy itself is extremely defensive. It just doesn't go out and blindly purchase randomly. The moving averages must line up perfectly to make the entry point. And then from there, it waits for opportunity. And as you can see, those entry points are few and far in between. Now, the thing about an accumulation strategy is, unlike the stop-loss strategy that can pick where to go in the market based upon what the market is doing, when you're using an accumulation strategy, you pick the direction and it stays in that direction. It's not an easy process to deal with, but it is a realistic process that works very well. So we have very little information really, but we have the foundations of how accumulation will do well over time for the same defensive strategy that we use to stop loss with. Now let's look at another approach that is based upon the Jackrabbit savings account paradigm, but much, much more aggressive. Significantly aggressive to the point of being dangerous. This is an always-in approach, and it is extremely aggressive. It uses Oanda's limitation of a worst-case situation of 1,000 positions per account, and it can be very aggressive. So as we can see here, the budget as the account grows, and the more accumulations it takes, the bigger the profitability. And that really is the point of this kind of a situation. This is the kind of trading I prefer. Opposition trading. This is where I make my money, by taking these kinds of risks, by understanding the balance between too much risk, meaning too many positions, and too little risk, meaning too little profit. You have to have a certain level of accumulation to make any real money. For example, if we look at the balance here versus here, we see very little change. So as you can see, the more positions you accumulate, the more profit you make. So you want, to some degree, a large number of accumulations. That is, you want and need the market to go against you. But at some point, the market has to correct and move in your favor to get the opportunity you need to sell off. So as you can see just how drastically this works, and it works well. But it has its costs. It has its restrictions. And it has its risks. And the risks for this kind of a situation are incredible. Because the more you accumulate, the more likely you are that it is going to spiral out of control. And that is our next example. Here we have a always in process, the same process I just described, but using a very, very difficult market. That is, this market is going completely against my trading process, and the accumulations are aggressive and vicious. So vicious that this particular trade cycles at one point used 48% of my margin. It could have very easily have pushed my account into a margin call, but the rewards for that were absolutely astounding. And let's get straight down to that. Here we go. Literally 297 positions. But this trade, this single sell point, brought in a $50 profit. So while its risks were extremely high, and it took 48% of my margin, $50 is remarkably good for the amount of budget I had and the amount of time spent in the market. For example, we see the sell took place on the 16th. Let's go back up and see when the first purchase took place. All of these positions are one single trade cycle, with the first purchase taking place on the 13th. So basically, a little over 48 hours, 48 to 72 hours, somewhere in that range. $50. That is very good for this market, considering the direction I was going. And that is, I was going in the long direction when the market itself was just losing money. So I was accumulating a lot of positions, 298 of them in fact, in order for it to really make the profit it did. So while the rewards were insane, the risks are equally as insane. But that is the kind of thinking you have to do when you are thinking about your strategies. And this is the kind of thinking that wrecked my account in July. I got too aggressive and it got out of hand. So while the rewards are just remarkable when they go in your direction, they can be devastating when they go against you. Risk is real. It's not an imaginary thing that just doesn't happen or shows up once in a while. Every trade you take has this risk. And trying to find the balance, trying to strike the balance between too much risk and too little profit is incredibly difficult. So as we finish this discussion, looking at my own personal equity curve, you can see where aggregation is critical. It's critical because you can actually do very well. It's critical because in doing so, you have something to really focus on. But there's one thing that I need to talk about with aggregation that this chart doesn't show you. And that is what happens when you combine aggregation with stop loss. What happens when you combine the two of them such that you have a strategy of 10 pips take profit or 1% take profit and 200 pips stop loss or 20% stop loss? That is, you marry the two ideals together, but you use extremely small position sizes. Well, what you get is something like this, that used Oliver Twist as a means of driving the entire process. So TradingView picked the entry point, set the take profit, set the stop loss, and then gave it all to Oliver Twist. From there, Oliver Twist produced this. This runs for roughly 2 months with extremely small positions. And I mean extremely small. You're looking at literally fractions of pennies of profit. As you can see with some of these, they're not very high. But when you go through it and you see how it changed over time, and you see how the profits adjusted dynamically based upon the market, you can see how it succeeded in ways that took aggregation to a whole different level. And that aggregation, surprisingly, did very well. When you look at the profits here, you don't believe this is going to really make much of anything in the long term. But in the 2 months that this process was allowed to run, it made $65. $65 on literally fractions of pennies. And it did so very well. Aggregation is your best friend when you use it properly. And it is really the second secret to trading. The first being risk mitigation, aggregation is the second. Couple the two together with some mechanism, whether it's accumulation or stop loss, and you have a very powerful profiting mechanism. You have a way to make money that can weather any market, as long as you've done your research carefully. So really, everything hinges on risk and aggregation. Master those two elements, and you can make real money in the market. You just have to make sure you have the patience to leave it alone. Because if you don't have the patience, this is what will happen. You will lose your profits. If you have the patience, you can do exceptionally well. And that is really the whole moral of trading. 90% of traders that lose 90% of their money within the first 90 days have no patience. They let emotion and greed drive their thinking. They make too many changes in their approach. They tinker with it constantly, with real money. They get too aggressive without realizing what their aggression levels really represent in a market that is nothing but utter and pure chaos. You have to take a reasonable, rational, sane approach to trading. Accepting that you are only going to use 10% of your balance is a safe way of guaranteeing long-term profitability. When you try to use too much of your balance, you get greedy, and greed is disaster. When you take your time and study the market and accept that losses will occur here and there normally, you can sustain any market shift. When you look at the ranges that you trade, when you think about the process that you want to use, and plan for the worst case scenario as commonplace, you can gain even more benefit over the market than the other 90% of people that have nothing but losses. If you have any questions, please feel free to leave them. Let me know what you think. Let me know your experiences. As I said from the beginning, my trading is my value. In other words, what I teach you isn't just how I make money. My teachings include also how I'm stupid and lose money, so that hopefully you don't repeat my mistakes. The market is a wonderful place to be, and it's a wonderful hobby. You may not be able to make a mortgage payment off of it, but if you take it in the context of a hobby as something to enjoy, it does offer a lot to benefit from, particularly when you don't have the stress of trying to make specific amounts in specific days. That is the biggest fallacy I really see traders coming into the market trying to do. They think, I have $1,000, I need to make $500 this month. And it isn't happening. Even expert traders that have been here for 20 or 30 years can't do that. All it takes is one trade, and they've wiped themselves out with that kind of thinking. At all times, under all circumstances, you are one trade away from losing everything. That can be mitigated with risk management, or it can be propagated with bad thinking. I hope you've liked the video. Share your thoughts, leave your comments, ask questions if you have them. Until next time.